Adrian Mowat of JP Morgan now joins us on this historic day when the Nifty hit 9,000. Adrian, hi, good afternoon. We were talking about it on the budget day that the market was light in terms of volumes and the real action would come over the next couple of days. But what's your sense? Do you think even after the kind of outperformance that we have seen, is the Indian market still good for more gains?
Yeah, I mean, the way we're looking at the Indian market is when it's had periods of low inflation and healthy growth, and we are forecasting 7% plus GDP growth for India, then it's typically traded on using the MSCI data at 17 times forward. It's about 16 at the moment. And we think that you have a dynamic for relatively strong earnings growth in India with the decline in input prices, lower financing cost as the RBI continues to lower rates, and this stronger top line generating operating leverage. When we look at all the major emerging markets, India is coming through as the one where it's easiest to articulate the upside.
Adrian, earnings have not really performed to expectations. How critical will the role of interest rate cuts be to help earnings get moving up faster, to get corporate India to a healthier balance sheet position, and therefore maybe to justify what some people call a slightly expensive market?
Yes, so I don't, and when we look at the valuation of the market, that's using the current consensus numbers, which we think are too low for the earnings that will be reported 12 months from now, which tends to be where capital markets look. If we're having a discussion in August, September this year, and there's no evidence of a pickup in activity and earnings, then I think we do have a serious issue with the equity market. So the risk to me with India is that you have a conservative corporate sector and a conservative consumer that doesn't respond to the stimulus that's coming through with the Reserve Bank reducing interest rates, and with a budget that was announcing a bigger allocation to capital spending and a commitment from the government to make sure that they followed through on that spending. So, let's see. I think we have an issue with this market if growth does not pick up and we're well into the third quarter of the calendar year.
Yeah, I'm sorry, I just want to distinguish between conservative and seriously burdened. And the only reason I'm making that point, Adrian, is just to see how quickly, India Inc. responds to some of the stimuli you pointed out. Maybe we won't see a response for a couple of quarters simply because they just don't have the bandwidth in terms of financials, or they're working at very low capacity right now to be able to respond to any kind of additional stimulus that would require private investment to come back.
Well, there's a real polarization in balance sheets. So you're absolutely right. Where the leverage is, it tends to be excessive. It tends to be in the areas where there's been policy issues. And then you've got many of the companies that are large benchmark components that have very good balance sheets. Now, you don't expect capital spending to lead any economy. It really has to be the consumer. But there is a part of capital spending that's non-private sector that can have a stimulus effect. So if India does execute and finish off the 100,000 kilometers of road that are being built, if we can accelerate the production of housing, those things can all be helpful at generating faster growth. And I think what the market will do with regards to private sector capex is if they are seeing an improvement in growth rates and operating rates, then they'll expect that late cycle activity to eventually come through.
Adrian, apart from earnings not catching up, what is the other domestic risk for this market? I mean, even if we were to leave aside the global factors, domestically, what else is a bit of a risk for this market? Well,
you do have the need to pass certain legislation, and the current government does not have a majority in the Rajya Sabha. And the political environment for consensus across political parties has been a little bit disappointing. So I think there's that risk, and the danger in moving towards a joint session of the Indian Parliament is that, again, that sort of fails to develop a consensus, and the legislative changes may prove to be more temporary.
Okay.
Sorry, I just have a question on how you would see this play out. Right? You've already told us that if we don't see earnings pick up, let's say by September this year, then you would be concerned about valuations in the market. Suppose we see a marginal increase in earnings, but we don't see some of these key legislations sort of getting cleared by that time. Would you relook at where we are, on the frontline indices at least, and say, look, we may have moved up too fast?
Yeah, so if you think about the sequencing of this, we need to continue to see the current trend, which is PMIs rising month on month, IP numbers picking up month on month. Unfortunately, Indian data on consumption is rather limited, so you'll use proxies like auto sales, two-wheeler sales, and you want to see those continuing to indicate that there's sequential improvement. And I think if the market is seeing sequential improvement in terms of consumer demand, plus evidence of real public sector spending increases, then that'll be sufficient fundamental support. Earnings will follow that, and the market will continue its current trajectory, particularly if that's hand in hand with the Reserve Bank of India moving short-term rates lower and long-term interest rates moving lower as people get more comfortable with a structurally lower level of inflation in India and a more modest current account deficit.
Nigel, Adrian, since the first time you upgraded India was in June 2012, and at that point I think the Nifty was somewhere around 5,000. Since then it's been an 80% rally on the Nifty, and the market has moved up from, I think it was 11 times then to what it is now. Do you think in absolute terms the Indian market is still good in terms of other Asian markets? Do you think India would still present more money-making opportunities than some of the other markets which may not have moved as much?
Well, the first time I bought India, the index was at 670, and it was August 93. So
I mean the last time.
Persistent.
I mean for this bull market.
Look, we will remain upbeat on the Indian market if we see a sequential improvement in activity within the Indian economy. So with a particular focus on the consumer, because you quite rightly point out that private sector capex doesn't lead this, plus a focus on public sector spending. If we see that, we continue to see low inflation, central bank cutting rates, then this market will continue to move higher. If we fail to meet those conditions, then we will moderate our position in the Indian market.
Okay, I have a quick final question, Adrian. That is, you've had some more time now to digest what the budget has had to say. Would your, sort of investment strategy, sector allocation in India change based on what you've seen happen in the budget?
But I think as we've had a chance to read the documentation rather than just listening to the finance minister's speech, there has been modification of views, for instance, around the consumer staple names, particularly tobacco names, very adversely hit by this. I think our conviction in being long building materials, cement companies has increased. And it's made us more positive on the private sector banks, really for two reasons. One is the technical reason around combining the FDI and the FII limits, but also the very small allocation in the budget to recapitalization of PSU banks continues to give a structural advantage to private sector banks.
All right, we'll leave it there this afternoon, Adrian. Thank you so much for joining us.